Hi there, I'm Keith Richards, Portfolio Manager, Value Trend Wealth Management, WorldSource Securities. Today we are going to try to answer the question, can you have your cake and eat it too? In other words, can you achieve better than market returns with lower risk? And to do so, I'm going to refer to the Value Trend Managed Equity platform that we run here at Value Trend Wealth Management on behalf of our clients. We're going to refer to our performance chart at first just to see if we actually have had lower volatility and higher returns, and then we'll go into the methodology that we have used to achieve these types of results. So the first chart is the performance chart, and you can see the black line is the Value Trend Wealth Management platform, the equity platform that we run for our clients. The other lines are different world markets, the top one being the top performing market in the world, the S&P 500, and TSX and emerging markets and European markets. So what you will notice here is we have beaten all of the markets with the exception of the S&P 500, but perhaps more importantly is the degree of volatility that we have taken on to achieve that performance. So if I go back to 2011, you can see that most of the world markets fell 20 to 30% during the summer of 2011 during that correction, and our portfolio, the black line, fell about 7.5% during that same period of time. As the market recovered, you'll notice that all the other indexes, including the S&P 500, were quite choppy, were quite violent in their movements. Our performance was substantially smoother along the way. Along comes the 2015 crash or correction, if that's what you want to call it. You can see the S&P fell, but also to a larger degree, most of the other world markets fell, to a greater extent. Meanwhile, the Value Trend Equity platform managed to maintain its capital by trading more or less sideways. So this is the kind of thing we're going to discuss today and how we did it. So before we get started on that, just to give a disclaimer for the performance on your screen on the previous chart. So how do we do it? What we do is we use three main strategies when we are managing money. We use macro technical analysis, in other words, how we feel about the markets overall. Should we be overweight or underweight cash? And that's really a big issue. Then if we are invested in stocks, and we do underweight and overweight cash aggressively, but if we are, say, fully invested, those stocks that we are buying, we want to make sure that they are fundamentally strong companies. So we are one of the only shops that we're aware of that actually has two distinct disciplines, one being fundamental analysis, one being technical. We are driven by the technicals as far as our macro overweight and underweight cash positions, but the fundamentals steer us towards what we will be buying. Finally, we have a sell discipline, and we'll talk about that as well. And really that's the hardest part of the equation, isn't it? Everybody loves to buy, but selling is the hard part. When do you sell? So we'll talk about that. So just quickly, in step one, our macro view is driven by what I call the four phases of the market, and we'll talk about where these phases are in each market cycle. So phase one is a bottoming phase where you are no longer getting higher highs and higher lows. Everything is more or less moving flat. A moving average, like a 30 or 40 week moving average, a 40 week is a 200-day moving average, will tend to move the market will meander up and down through that moving average. We can often identify when the market will move into an uptrend, which I like to refer to as phase two, when the peaks start getting higher, the troughs start getting higher, and the market moves above the moving average. Once again, a market can go through a topping phase, I call it phase three, same sort of pattern as you see in a bottoming phase where the market moves up and down around the moving average. And once the market rounds over and starts to head down, you see that pattern of lower highs and lower lows, and it tends to stay below that 30 or 40 week moving average. I call that phase four or downtrend. You will find that all markets trade within those phases at some time. So let's take a look at the S&P 500. I've got data since 1990 here, so a good 20 odd years of data, and we have a very obvious series of the phases. So we had a base here in the early 90s, followed by an uptrend where it moved above the 10-week moving average, which is the same as a 40-week, which is the same as a 200-day moving average. You can see it broke the moving average here. It made lower highs, lower lows. We moved into a downtrend. There's your new phase one, bottom phase. Again, the moving average wasn't of much help at this point, except for the fact that when it broke and we took out the old high, we moved into a new phase. So one of the things we at Value Trend do is we look to identify which phase we're in. And you can see by the chart here that according to this prognosis with a series of, on the bigger chart, this is a monthly chart, we have not yet distinctly broken the 10-month moving average, although we have spiked below it a little bit, but we haven't officially broken through it by at least one bar, or in other words, 1 month. So at this point, I have to identify this market as a bull phase, despite the fact that the summer has been very shaky, and we did raise cash back in April. Now, I'll get to that in a minute, how we raised cash and how we managed to maintain our clients' capital this summer while the market was falling, the summer of 2015. We have to understand that markets move in cycles, just like those phases. And it's because cycles happen because human nature is always the same. People say, well, isn't program trading or isn't, the world market events changing things? All those things change, but human beings do not change. We always have the same reaction. We are greedy, we are fearful, and everything in between. So this little market cycle diagram that I pulled off of the internet from somewhere, I can't remember where, really tells us why those phases, why those cycles happen, because we basically move from periods of excitement to periods of outright despair and everything in between. So the market will constantly, human beings will always be the same, despite all the wonderful internet and program trading and all these things that seem to be driving the market. Those things drive the market in the short term, but in the long term, it's going to be human nature and the traders that move things. So this is more than 100 years on the Dow Jones Industrial Average, and what I want to show you here is that beyond the shorter term cycles that we look at, there are even very large secular market cycles. And you can see back in the early 1900s, there was a sideways cycle, the great crash of 1929, but that led into a bull phase, which lasted over the 40s to 1962 or so. And then during the 60s and right into about 82, I think it was, the market moved sideways. The Dow was trapped under a lid of about 1,000. In 1982 or 83, it broke out into a new bull market, higher highs, higher lows. And once again, we went into a new sideways phase that lasted from basically the first tech bubble to the implosion after 2008, and then the subsequent rally out of that sideways market in 2013. So according to this prognosis, we are officially in a bull market, and if you look at the length of the bull markets and even the length of the sideways markets, typically these things will last for about anywhere from 7 to 20 years. So let's assume that if the market broke out in 2013, that we should be in an overall bull market for a number of years. So we are mindful of this at Value Trend, that we are in a long-term secular bull market until proven otherwise. Now, another cycle that we pay attention to is seasonal cycles. A lot of people might have heard of sell in May, go away, and that is something that was coined by Don Villu, great market technician and a seasonal expert. This is his son, John Villu. He owns a website called Equity Clock, and John has done a lot of charting of individual stocks as well as markets, but you can see that over the past 50 or 60 years that John's data shows us that the markets do tend to trade more or less sideways with a slight downward tilt for most of the summer, and then when markets tend to fall, as we know, is September, October tend to be the worst months. So this is the reasoning behind the sell in May, go away strategy, and that is that most of the gains tend to occur between about November to May. So these are the sweet spots to be in the market, and then the market can be choppy, not always, but on average, it's a cycle. Markets tend to be a bit weaker during the summer. This is research by Brooke Thackeray, and he writes a book called The Thackeray Guides. And basically, he shows us that if you invested $10,000 in 1950 to 2014, if you bought every May 6th and sold every October 27th, you lost about $2,500. over all that time, over 64 years, versus if you took the same $10,000 and did the opposite, bought every October, sold every May, you made a cool $1.3 million. The rhetorical question is, which would you have rather done? So remember, it's a numbers game. It doesn't happen every single year, but these are one of the cycles that we at ValueTrend pay very close attention to. There's also cycles that happen within different sectors. So we pay attention to these sectors. For example, in October, which is coming up at the time I'm making this video, we want to be mindful of the infotech sector because it can be a good time to buy infotech. You don't automatically run out and buy infotech just because it's October, though. You have to pay attention to the charts and take a look at the cycles, the phases that we were just looking at to see if the sector, in fact, is looking like it's going to break out. So the next macro thing that we at ValueTrend look at, in fact, I wrote my thesis as a chartered market technician on sentiment, so I'm a little bit of a quasi-expert in this area, and so we look at smart money versus dumb money. And basically smart money, some people take offense to these terms, but just to understand that these terms have been around a long time, I didn't invent them. Smart money tends to be those in the know, so commercial hedgers, large pension managers that might trade index equity futures. Dumb money tends to be the retail investor, and by the way, that's me too. So we're all dumb money. The point is that we have to realize that we're dumb money and try not to act according to our instincts, and instead we want to act like the smart money, or at least follow what the smart money is doing. And there's a really good way of following what both the smart money and the dumb money is doing, and that is at a website called sentimenttrader.com. I subscribe to their research. I've copied this particular chart from their website as of, it was taken I think at the middle of September 15th, 2015. So the numbers are always changing. But what I want to illustrate here is the red line is the so-called dumb money, retail investors, typically mutual fund buyers. They tend to be the most excited when markets are high and the least excited when markets are low. So in fact, smart money, which is the blue line, they tend to be least excited when things are high because they know things are getting overvalued. So what you want to do is, if you see a large gap between them, as we did in March of 2015, we know that the smart guys are selling, or at least staying out, and the unsophisticated money is buying. So one of our signals that we used at ValueTrend was that to sell in April, we sold in April, was that markets were looking a little bit dangerous according to what the guys in the know were doing. Now remember, this is a leading indicator. We ended up selling in April. The signal came in March. We didn't just use this. We used a number of other indicators such as breadth, like how much participation was going on in the market. The market was actually rising at that time on very little participation. We use volatility statistics. If the market's not volatile enough, we feel that there's not enough fear out there. We use a number of things, but this is a very simplistic way of looking at it. We got a signal. A lot of those things were signaling in March. We made the decision to sell in April. Guess what? The market went sideways from there, and then it fell in August. So it's a leading indicator. Just because it's signaling buy or sell right now doesn't mean it happens right away. Now look where the indicators are right now. The smart money actually got very interested in the market right around the August 2015 decline. Look at what the dumb money or the unsophisticated money was doing. They were panicking. Meanwhile, the smart guys are picking things up. So even now we see quite a wide margin between the sophisticated investors and the unsophisticated investors. So this is a signal for, at this point, and I'm doing this video on September 17th of 2015, it's telling us that sometime, probably in the coming weeks, the market's going to start heading up, okay? It may get another blowout bottom before we see that rally. It's a leading indicator, but the point is things are looking good. So let's get on to step 2, fundamentally strong stocks. Now, I'm the technical guy, technical analysis in ValueTrend, so I'm the lead portfolio manager, but we have Craig Aucoin, and he does the fundamental analysis. I want to keep this video short, so I'm just going over some of the factors that Craig uses, and believe me, there's a lot more to it than what I'm going to show you. But basically, Craig is looking for companies. When I give him a technically strong company within a macro environment that I think is favorable for a stock market rally or rise, then I'll give him a list of stocks that look technically attractive. Craig from there looks at the management team to see if they're a stable management team. He looks at earnings growth. Now, not earnings growth can be achieved by cost cutting and firing your employees to keep the earnings going. But of course, that's not generally a great strategy for long-term earnings growth. So Craig looks at earnings growth based on new revenue, increasing revenue, not cost cutting. He looks at margin expansion. He looks at their balance sheet to make sure they're not too over leveraged. And he looks for, of course, a reasonable valuation. So that's step 2. We use the fundamentals, and as I said, I'm not doing it a full service there, but it's at least a reasonable guideline as to what we look at from a fundamental point of view. So we've got both macro technical, individual technical screens, and then individual fundamental screens on the stocks. Finally, we have a sell discipline, and if there's anything you get out of this video, please pay attention to this sector, because most people are okay at buying stocks. It's selling that's the hard part. So we are largely technically driven when we sell. And so we're looking for, if we see a trend line break, which again, remember I mentioned that a phase 2 uptrend is defined by higher highs and higher lows. Well, as soon as we stop seeing higher highs and higher lows, and in fact you get a new low and a new high that is lower than the last high and low, that is defined as a trend line break, and I'm going to show you a chart of that in a minute. So lower high, lower low, that's a trend line break. And also I like to see a break of the 200-day moving average, which is also a 40-week moving average, which is also a 10-month moving average. So what I want to see is these indications before I sell. So we're not selling on the spikes, and often you get spikes. And I often also use a rule of 3, and that is that just because it breaks the 200-day moving average, for example, it makes a higher low and lower low, I'll give it a few days, at least 3 days, sometimes up to 3 weeks before I make my move. And that's because during market extremes, such as August of 2015, you got a lot of those spikes of the 200-day moving average. You're not going to sell out of stuff that's relatively in an uptrend just because they had a 1 or 2 day spike. So Craig, on the other side, we are less inclined to sell on fundamentals, but if Craig notes that earnings per share growth is declining and the balance sheet is deteriorated, or the company has become overvalued just based on price appreciation, we will sell. Okay, so this is a good example. This is Enerplus, which is an oil and gas company. We bought Enerplus on a phase 1 breakout. There's a consolidation. We bought it right here. It broke out, tested, we bought. Now you're in an uptrend, phase 2 uptrend, higher highs, higher lows. We kept the stock. What we noted was that Enerplus in the summer of 2014 started to break down. There's the old low. When this low was broken and the 200-day moving average, which is this blue line here, was broken, we said, okay, we've got a lower low, a lower high, and there's the high, there's the low. We've got a lower low, lower high, and a 200-day moving average break. We knew it was time to sell. And sometimes we're wrong. Sometimes the market goes sideways from there. Sometimes it even rallies up. But we give it a few days. And once that is confirmed, that is a genuine break, and it's more than a week, we're out. In this case, it turned out to be an extremely good decision because we profited on a stock that buy and hold investors have most certainly been at a disadvantage in. So again, with value trend and anything even that you on your own could choose to do, which is you have to have what we call a Chinese wall between the two disciplines. In other words, don't let your fundamental bias influence whether you hope to see a trend of some sort, and don't let the technical bias influence the fundamentals. Just because you see a strong trend, if the company's not sound, you don't buy it. So we have two different people, and we actually don't bother each other once we've made our own analysis. We do not try to influence each other in any way. By the way, most portfolio management shops, they have a roundtable approach, but they might have a technical guy at the table and a number of fundamental people, and they discuss it as a group. We don't believe in doing that. We should not discuss it as a group, because if one guy could be influenced by the stronger willpower of the other, for example, the fundamental guy may sort of muscle the technical guy into conceding that you could buy it based on some weaker technical signals, just because the fundamental person so badly wants to own the stock. So we have two very distinct disciplines that don't interfere. We are also small enough. Currently, at the time of this video, we're managing about 125 million. It sounds like a lot of money to some people, but it's very small actually. And so our advantage is that when we want to raise cash, case in point, we raised 50% cash this summer, and our clients are very glad we did. We avoided that big crash in August, as well as the sideways markets over the summer. We were able to do that very easily. A $2 billion pool of capital, I think it's a little harder to raise half of that in cash by selling your stocks. You'll move the market by doing that. So we do market timing, but we base it on risk reward, not on exact peak and trough. And you can see, you've just seen an example of our analysis. So in conclusion, what you will want to do if you're doing this on your own, or if you're looking for a portfolio manager, use somebody that can identify the phase and the trend. And the other thing that we believe in that's coming soon is sector rotation. We believe that a lot of the bull market rally is over, and things are going to get a little bit harder for investors, so it's not going to be so easy to just blanket buy stocks or mutual funds and watch them go up. So we're looking for stocks that exhibit technical breakouts or that are testing an uptrend, and we're looking constantly for the rotation into those stocks that experience new technical breakouts. And we are adamant on that you need the technical breakout and you need a fundamental catalyst to continue with that technical breakout. So final disclosure that anything that we discussed here, we may have positions in, and it's for information purposes only. By the way, I do have a couple of books. If you're interested in the subject of technical analysis, I might steer you towards my book Sideways, and you can buy that at Amazon or Indigo. Thank you for watching.